We go. Hey everybody, how we doing today? Pete Peterson here with Dream Huge Realty, 419-528-8260, online at dreamhuge.com. Work hard, never give up, and dream huge. With my man Justin Bigelow. How you doing today, sir?
Too bad.
And with my other man, my new friend, Mr. Greg Smith with IPX, 1031 exchange specialist. So thank you for joining us, Greg. How you doing today?
I am very good. Yeah, thanks so much for having me. And today we're going to talk about 1031 exchanges, just spend 20-25 minutes going over some of the important things about how Section 1031 can make you a lot of money as an investor, as a real estate agent. It is absolutely your best friend. So in its most basic terms, a 1031 exchange, which comes from Section 1031 of the tax code, is the idea that when you sell your property, if you don't want to pay all of the state and federal capital gain taxes, which we'll talk about in a moment, and instead you want to reinvest your money into more real estate, the IRS is nice enough to say that there's a way to do that, and then they'll avoid having to tax you on your initial sale. So
right, we want to get away from paying those capital gains, correct?
Absolutely, yeah. They're brutal.
And what is that? You have to live in if you live in a house for more than how long? I mean, I'm sure we'll get to all this. I may be jumping the gun, but what are the stipulations?
Well, sure. Now, with a principal residence, so if you live in a house, that's Section 121. And what it says is if you've lived there for at least 2 of the past 5 years and you haven't sold any other home in the past 2 years, then the vast majority of the time, it's a completely tax-free sale. So you have to have more than $250,000 of gain as a single filer, or more than $500,000 of gain. There goes my dog there. $500,000 of gain as joint filers before you have to pay any taxes. So
if it's your primary residence, you need to have $250,000 of gains to even worry about paying capital gains on your primary residence.
Yeah, that's exactly right. So you almost never have to pay gains on your home, but when you're selling any kind of property you use in a business or investment property, that's where Section 1031 generally comes in. Yep. And here's the basic code section itself. And I won't read at you today except for this, but no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, as long as you trade it for the same thing, more property held for productive use in a trade or business or for investment. So that's what the actual code section says. And
so can important. So like kind properties, that I get asked about that a lot. How like kind are we talking?
Sure, it's incredibly flexible there. Like kind means any type of business or investment real property can be traded for any type of business or investment real property. So it's okay to sell a rental property and buy farmland. It's okay to sell a shopping center and, buy a strip center. You can do anything you want. So
sell a multifamily, buy a commercial warehouse, rental space.
That works. Yep, that works perfectly. So something else you'll hear, the bottom left corner is what we call contract cooperation language for a 1031 exchange. And you will hear a lot of attorneys, CPAs, real estate agents, and other advisors tell their clients, you have to have this language in your contract that says you're going to do a 1031 exchange and that the other side agrees to cooperate. Well, there are some very good reasons to have that language in your contract, but it's actually not required by the IRS. So it's not going to kill your deal if you don't get that language in the contract. But at the same time, for reasons I won't bore you with right now, it still is a good idea to put that into your contracts. Again, just mentioning that you're doing the exchange, that the other side will cooperate. People often throw in at no expense or delay to the other party to make them more comfortable. In the end, your 1031 exchange does not affect the other party in any way, shape, or form. But the IRS does require that you make them aware of the exchange. So it doesn't have to be in the contract. Our documents as the qualified intermediary will take care of that. And I'll just mention quickly that the IRS does require you to use a company called a qualified intermediary. Our main goals in this process, we have to hold the money until you reinvest it into your new property. And we also do all the paperwork that would keep the IRS happy should they ever decide to audit and look at you. These definitely are not an audit magnet. I've been doing this now with IPX for 19 years. Knock on wood, I've not had a single client out of many, many thousands of clients get audited. So, we do see some audits nationwide. They happen from time to time, but they are very, very rare.
Very good. Yeah, and I get asked that a lot too. Like, who can do a 1031 for me? Can I call an attorney? Can the title company do it for me? Well, you answered that question, right? They need to be a QI, a qualified intermediary, in order to handle those funds and file everything correctly with the IRS.
Yeah, that's exactly right. And specifically what they say is it can't be any party that you've had an agency relationship with in the past 2 years. So you can't use your regular attorney or your accountant or your real estate agent or your banker. They do carve out an exception for title companies that if the title company is only offering normal title services, not going beyond that for the customer, they could also act as the qualified intermediary. But in general, you need to make sure you're using someone that's considered a principal in the transaction and not your agent. So yeah, great question.
Gotcha.
So I'll mention real quick here, the taxes. I don't think I've updated these numbers in the last year or so on this particular slide, but everyone thinks of this as a 15% rate. I hear that all the time from clients. Well, long-term capital gain rate's 15%. That's not the end of the world. Well, you're going to find out it's a lot more. Now, not everyone, of course, is hitting these income numbers, even when you count the gains from your real estate. But if you hit a high income, it does jump from 15 to 20%. And then the Affordable Care Act at a smaller income level, but again, this includes a lot of things, your day job income, your capital gains, the capital gains from the real estate. If you go over these numbers, it jumps up another 3.8%. And then people forget about depreciation. So that's that idea that our buildings are crumbling away over time. But that's a beautiful thing as a real estate investor because they give you a tax break based on that. If you go out and let's say you buy $1 million property where the land value is $100,000, the building value is $900,000, then you take that $900,000, and if it's residential property, you divide it by 27.5 years. If it's commercial property, you do 39 years. And that number then is your tax break you get each year on this theory that your property is becoming less and less valuable over time. So you can use that credit to offset your rental income coming in and avoid a lot of tax through the years of your investment. However, when you go to sell the property, if it turns out that it didn't go down in value, but instead it went up in value, now Uncle Sam is going to stick his paw out and he's going to say, hey guys, we shouldn't have been giving you those tax breaks. They're going to take the total of credits throughout the years and tax that at 25%. So that can be an absolutely brutal tax. It can also surprise a lot of clients because clients are thinking that maybe they had a bad investment. Maybe it didn't go up in value in their mind, but they forgot over the years all the depreciation credits they were taking.
They still have to pay back those depreciation credits.
That's right. That's right.
Yeah.
Unless the property went down in value by the amount of the credits, so they really did lose money on the investment, then they're going to get hammered by that tax.
Mm-hmm.
And finally, people forget about state tax. So in Ohio, it's not the end of the world at 5%, unlike out there on the left coast where it's 13.3% in California. But still, another 5% certainly adds on. So when clients come in, they say 15%, it usually ends up being something more 20, 25, even 30% when all is said and done. So just quickly pointing out the takeaway there is that taxes are always a lot worse than people think. And there's always that much more incentive to go ask your real estate agent to find you that replacement property. Now, like you asked earlier about like-kind property, Yeah, it is anything for anything. It's okay to sell retail and buy raw land, sell apartments and buy industrial. It is very flexible, which is great. And here's something I want to spend a minute on that clients don't always understand. So I had this conversation with a gentleman this morning where he was convinced, and even his accountant had told him that what he needed to do was just reinvest the amount of his gain from his sale. And unfortunately, that's not correct. I wish it was that flexible, but the way they look at it, they want you to fully reinvest in a new property. If you sell property for $100,000, let's ignore closing costs and say there's no debt on the property. You'd be walking away with $100,000 in your hand. They want you to take that full $100,000 and go buy new property. Then they can pretend like nothing's changed and they don't have to tax you on that sale. If you kept $10,000 of the $100,000, they're going to tax you on that $10,000 as cash boot in the transaction. Now, if the client is selling for $100,000 and paying the bank $40,000, now they've got $60,000 of cash. IRS wants to see that as down payment on the new property. Plus, they've got $40,000 of debt they paid off, so they want to see a new loan of $40,000 or more. So everything again matches up. Then no taxes will be due. Now, just as a quick side note, it's okay to match up that debt with more cash. So if they walk away with $60,000 in cash, had paid the bank $40,000, they can use the $60,000 as down payment. But if they've got another $40,000 in cash sitting in their other bank account and they would rather use that than go get a loan, that works fine as well. They'll still stay 100% tax deferred in that example also. So it's not based on how much gain you've got. It's not based on how much money you think you've made in the transaction. It's really based on your sale price, and they want to see that match up. And technically, it's the sale price minus closing costs. So title company fees, closing fees, real estate commissions, those come off the top. You're not expected to make up for those, but whatever's left, they want to see you reinvest. All right, I'm going to skip through this page for the moment so we can keep this.
Any questions yet, Biggie?
You mentioned about the bank, paying a bank back. Personally, I've done hard money. How does that apply with trying to prove money and everything?
Sure. So the IRS either wants to see an actual debt against the property, so any actual mortgage that needs to be paid off so the exchanger can sell the property, that's
Okay.
no problem. If it's something else, and something we see all the time is people who took money on, say, a home equity loan, but then use that money towards their investment property.
Mm-hmm.
The IRS is okay with you paying that off, but the key is that the money can never touch the exchanger's hands. So what's going to need to happen in any of those types of situations, you're going to provide the title company with a payoff, and the title company will then pay that money directly to the lender, and then it works as far as the 1031 goes.
Gotcha. So if I'm just got like a loan through somebody else and we got a mortgage drawn up and everything, I would just submit all that paperwork to them instead of.
Yeah, if there's actually a mortgage, then that's simple as can be, because obviously the title company will require that payoff so they can release the lien and give the new buyer clean title. It's when there's not any kind of mortgage, maybe there's not even a formal note, then that's where you can still do it. You can still have the title company pay it off. You have to give them some kind of payoff statement. They'll pay that money directly to the lender. And if the IRS were to ever audit, as the exchanger, you'd need to show, oh no, look, I can show how I actually use this $50,000 towards the subject property.
Okay.
If you did, that's perfectly legit.
Gotcha.
Now, people always want to have extra time, but here's how the time limits actually work. So from the date of the closing of the relinquished property, so the property you've owned for the last, let's say, 8 years, and you're now selling it today on February 17th. Well, from this closing date, you'd have 45 days to identify what you may want to buy as your replacement property. We'll talk about the ID rules in a few more slides. And then you have 180 days also from today to get closed on your new property. So 45 to identify, 180 to get closed.
Greg, question.
Yeah, please.
Can we get them to reverse that somehow? Because what's difficult from our point of view, I would like longer time to identify the property because heck, we only need, 30 to 60 days max to close.
Absolutely.
And I would like to shop longer because a lot of times my investors, they're like, man, I feel like I'm in such a rush. I got to find something within 45 days. But I guess that's the pressure they put on us because they're like, you either find something or we're taxing you on it. Is that pretty much the gist of it?
I mean, you are 100% correct, and I agree wholeheartedly with you, and I think almost everybody does. But this comes from a very old-fashioned notion of what 1031 was, because believe it or not, right now we are celebrating the 100-year anniversary of the 1031 exchange. It went back in the tax code back in 1921, so it's been around a long time. Well, for several decades, what people were using 1031 for was really just for two-party swaps. So you have the property I want, I have what you want, and we would trade deeds. And that's kind of how the IRS started thinking about these, really until the 1980s, when you started to see people get a little more creative with how they use this section of the tax code, where they would sell to one party and go out and buy from somebody else. And so when the IRS saw people were doing that and started adding more and more rules to how that would need to work, they were really of the mindset that this was still a two-party swap. So this time limit was just extraneous and really, really giving on their part to give you any time at all. So they thought the 45 and 180 was miraculous, whereas really they could have made this very easy and just said you have to get it done within one tax cycle. So then you could have had longer than 45, longer than 180, just report it on your next tax return and you're good. But I think that would have been too simple. So we're stuck with what we're with.
Of course.
So we've got, it is a no mercy thing as well. Once you're to day 46, you are locked in with those. So a lot of your clients, they want to work hard to find what they want to buy even before their sale goes through. It's okay to lock it into contract before the sale happens. Sometimes we do what we call simultaneous closings, which is really you close with a title company at 2 o'clock on your sale and then 3 o'clock on your new purchase. So that's great. That can work well. But you're exactly right. 45 days can be tough, especially in a marketplace like we're in, where it's a seller's market with not a lot of inventory. So
yeah, so you're essentially you'll want to get it in contract within those 45 days, because if you just have it basically identified and you go past the 45 and you get outbid or something, or it's not technically in contract yet, you lost out on the deal.
Absolutely, you are completely correct.
So then you would suggest then get it in contract and get the contract turned into your into you, or the qualified intermediary, correct?
Yeah, and in a lot of exchanges, they are closing in the first 45 days. And if you do that, you don't even have to identify. But if you know your closing date's going to be after day 45, absolutely try to get in contract as quickly as you can. And then sometime before day 45, you'll return the form we send you with the identifications noted. So it's fairly simple process most of the time, but like you said, the hard part can be finding what you want quickly.
Yep.
Then they came up with these strange identification rules, and the first one sounds simple enough. The 3 property rule means you can always identify any 3 properties with no restrictions as to price or anything else. Then people said, well, hey, we want to identify 4 or more properties. What do we do? And sometimes it was because maybe they wanted to sell property, let's say for an easy number, $1 million, and they wanted to go out and buy properties that were $250,000 and diversify. Well, you can't do that if you can only identify 3. So they came up with the 200% rule. So if you sold property for $1 million, your 200% would be 2 million, which would mean you could go out and you could identify 8 properties that average 250,000 to stay within that 200% limit, but the IRS won't allow you to name a 9th possibility. Then there's a strange 95% exception. It says, hey, if you broke the first 2 rules, but you buy 95% of the value of everything on your list, we'll still accept your exchange. Bottom line is that's way too risky. You want to stay away from the 95% exception. Just go with the 3 property or the 200% rule. 90% of the time, people use the 3 property rule. Maybe 10% of the time, they use the 200% rule. And that only really works when you are identifying some properties, at least of lesser value compared to the value of the property you sold. So these are strange, but we help clients through and try to make sure they're doing it right. All right, I'm going to skip this real quick on the safe harbor. I do want to mention there are different types of exchanges. So let's say your client comes to you and you are in this hot marketplace, which is a seller's market in general across the country. And they say, hey, I found the perfect property. I have to close within 30 days or it's going to go to somebody else. So I've made my deal, but now I don't have my property sold yet. And we're going to go out and get it fixed up and on the market. And I think it'll sell quickly, but it's not going to sell before I have to buy my new property. Well, then you can do what's called a reverse exchange. Buy first and sell last. So the good news is the IRS gives you a way to do it. The bad news is they do not make it easy. Okay, they say you're not allowed to own both properties at the same time. Well, if you're buying first, what does that mean? Well, it means you have to use a friendly party called an accommodation title holder to step into your shoes and take title to the new property. And from that closing date, you have 180 days to get your old property sold and complete your exchange. So as a practical matter, we set up a new LLC. We take title on the client's behalf. They're still paying for it. It's their money or their lender's money, just like normal, but we're in bare legal title. They'll control the property totally from day one, but we're just there to make the process work. Now, a build to suit exchange or a construction exchange, or sometimes called an improvement exchange, is where your client might be selling property over here for $500,000. He's buying land worth $100,000, but it's going to put $1 million building on it. Well, you want to be able to count some of that building value to get full tax deferral from that $500,000 sale, of course. So it's a little bit of the same idea. We take title to the new land. The IRS gives you the rest of your 180-day period to get as much construction done as you can. And then we're going to deed the property over to the client. They'll get credit for its value at that time. Reverse build to suit puts those together. So you're buying first and doing construction, then selling. So there are some creative things you can do. They do take a little more planning than a standard exchange.
As you may have touched on this, but does the reverse cost more to do?
Absolutely. So a standard exchange costs are pretty low. I would say a standard cost sort of across the industry to do a standard exchange where you sell first and buy last with one closing on each side. Most of the bigger companies are charging about $1,250 to $1,500 for that whole process. With a reverse or a construction exchange where the company actually has to go into title to make it work, fees are much, much higher. You're looking at about $5,000 on the low end. And then if you're doing construction on a $50 million property, it may be $7,000, $8,000, $9,000 on the high end. But yeah, they are more significant costs. So you'd want to factor that in and, make sure the tax hit on the property you're selling would justify those kind of expenses.
Gotcha.
All right, skip that for the moment because I do want to keep this just to a couple more minutes. So we're staying within our time frame here. So again, what's important to know about a qualified intermediary, again, the IRS requires you to use one, is that this is an unregulated business. Okay, so almost anyone can do it, even though there are those disqualified parties we mentioned earlier, such as agents. You can't have an employee do it, things like that. But anyone else can go and do it. You don't need to earn a degree. You don't have to prove you have any qualifications. So there have been some bad apples that get involved, right? They want to hold millions of dollars of other people's money, and some bad things go on. So what you want to look for when you're picking a QI, you want to look for fidelity bonding. You want to look for heirs and omissions insurance. You want to look for a third-party guarantee of funds, so that you need to really ask the question, hey, if someone runs off with my money, how am I getting it back? And they ought to have a good answer for that. They ought to have bonding and insurance and things that is on the hook to make people whole in those kinds of situations. So be aware that it's a little bit of the Wild West. It's a little bit of an unregulated industry, and you do want to be careful who you're working with. Guys, what other questions could I answer for you in the last couple minutes here?
I think that
Anything you'd
pretty
like me to
covers,
touch on?
pretty much covers everything for me. What about your contact info, Greg, if anyone has any questions for you directly?
Yeah, and I don't know if it's going to show up on the last screen. Let me jump ahead here. Well, there's our website anyway. I guess I didn't add to this one, but so again, my name is Greg Smith, and my phone number, anyone can call anytime with any questions. We don't charge anything for consultations, so you can run a scenario by us. We'll spend a lot of time with you telling you what works and what doesn't. There's never any charge for that. So my toll-free number is 866-443-1031. And my email address is Greg, Greg, .Smith. You can handle that one. And then at IPX1031.com, like you see on your screen. Greg.Smith at IPX1031.com. So yeah, feel free to email or reach out at any point. Never any hard sell. If you do the exchange, we'll explain exactly what the flat fees will be. So it's very, very simple and straightforward.
Awesome. Well, I don't think I have any questions. I think that was an awesome overview, and I'm going to continue, if you don't mind, share that with our clients and friends. That's great information right there, Greg. So thank you very much.
I appreciate it. Thanks for
Doesn't
having
seem
me.
as complicated as I thought it was.
Right. Yeah. So
Yeah,
now we have.
Most exchanges are truly pretty simple. You can get into complicated situations where you've got partnerships, entities where some people want to exchange, some people don't. You might have to take certain steps. There can be some complicating factors if they have related parties involved, if they're doing seller financing. So, I could bore you for hours and hours on this stuff, but most exchanges are simple and straightforward and work very, very well.
Excellent. Thank you for the info, Greg. Again, Greg Smith with IPX 1031. Justin Bigelow, hashtag sell with Bigelow,
That's right. Hashtag sell with the champ.
hashtag sell with the champ, and Pete Peterson with Dream Huge Realty. Work hard, never give up, and dream huge. Have a great day, everybody. We'll see you. Thanks again, Greg. We'll be in touch.
Take care.